The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, it's my Chanticleer colleague. He's stronger than the Australian dollar. It's Anthony Macdonald. How are you, Anthony?
I wish I was at a 4-year high this week, James.
Oh, you're always at a 4-year high. This week we look to unpack another rate rise and what Michele Bullock said about the next 6 months. We take you inside the room at the biggest meeting of Australian companies and investors, and we preview the federal budget, which is only a few sleeps away.
But first, James, let's start with a bit of news from Friday morning. We got one of the juiciest results of the year. Macquarie Group's juicy because the numbers are normally big. Macquarie reported a $4.85 billion profit, one of its best ever, with revenue earnings up across all of its divisions: commodities, asset management, banking, investment banking. But James, the story's always in the pay tables here, isn't it?
Oh, we're so crass, aren't we, Anthony? We go straight to the remuneration table.
Yeah.
How much did Shamara Wickramanayake get paid? Oh, it's $26.5 million. That's a fair bit, isn't it?
Solid.
But the story here is actually what she didn't get paid. She took a pay haircut of $7 million or 21%, Anthony. That's a fair whack. This goes back to that story last July where at Macquarie's annual general meeting, they got a protest vote against their remuneration report. Basically, investors thought, hang on, Macquarie, you've had too many issues with the regulators, too many sort of quasi-scandals, but none of your executives have taken a big pay hit. We don't like it. Here's a strike against your pay report. All pretty embarrassing for Macquarie, if I'm honest. And really the board has said, no, we've listened. And it looks to me, Anthony, like Shamara's jumped on the grenade. She thinks that the Macquarie's pay structure, which is basically incentivise top people by paying them lots of money, is really important. It feels to me like she's taken a big haircut on her pay to make sure that she can preserve that pay structure, which she sees as really important to the Macquarie model. Couple of other numbers from the pay report that are worth noting. $24.1 million, that's the pay of a guy called Ben Way, who runs the Macquarie Asset Management Division. Now, that almost doubled on last year's pay because MAM had a big year. It sold a number of businesses or announced the sale of a number of businesses. There was Air Trunk sale. The performance fees from that are starting to come through. There was a sale in October last year of a company called Aligned Data Centers in America. Some performance fees from that coming through as well. But the big number in the pay, Anthony, get ready for this.
Yeah.
Simon Wright, the head of the Commodities and Global Markets Division, took home $35.2 million. Well,
nice.
When I say took home, the Macquarie styles actually defer a lot of that profit share. So he's not taking it home yet, but he's been awarded that big number, and that came from a big profit boom in the CGM division. Profits there jumped 49% to $4.2 billion. It's a big whack. Now, the CGM division can be pretty volatile. They sold a big business, a smart meters business in the UK, so that helped the profit. And of course, when you see volatility in the world, and there's no greater source of volatility at the moment than the war in Iran, that means you get plenty of trading activity for the commodities division, and their profits go up as well. So look, we've only had a month of the war in these numbers because they only go up to March 31. So you'd expect there's some more good, healthy profits to come from the war in Iran for Macquarie. What did you make of it all? It felt a little bit to me like Macquarie's got its groove back. It was a very Macquarie result, if that makes sense.
Yeah, I think it's fair to say it's got its groove back, James. Probably third highest profit ever. The first two are the ones around the Ukraine invasion when they happened, 2022, 2023. Macquarie does well in times of this energy market's volatility. That's when it makes its super profits. Like you, I'm interested in the compensation at the bank. It's about 40% across the bank. So about 40% of every dollar brought in net revenue gets paid out to staff. That's about what you'd expect in the industry, slightly lower than last year. But I mean, I think that tells you it's a fat year. I'm interested in your take on Shamara's $7 million hit. James, you reckon this is Shemara hugging the bomb, though, rather than it being lobbed at her?
Oh, well, a little bit of both. But the reason I say she's sort of jumped on the grenade a little bit, you look at how everyone else's pay has been marked down, and you're talking about markdowns of 5% to 10%, nothing like 21%. So, I mean, I think it's right that the person at the head table takes the biggest hit. The buck stops with the CEO, as we're always told. So that's totally fair enough. But I think Shemara is a big believer in this Macquarie model, in that pay model, and how important it is keeping the Millionaires Factory running. So I think, yeah, she has taken a big hit, probably for the greater good of the place. I don't know. Am I being too generous?
No, I just wonder whether it was her or whether it's the REM committee, to be honest. Like, as much as CEOs love to take the blame, I wonder whether that's a case of you put your hand up for it or whether it happens to you. It probably doesn't matter either way. But yeah, you're right. 25% of her profit share allocation is gone. That's the $7 million. The next most was 15% for Greg Ward, who runs the local banking and financial services business. It has Macquarie's platform, the wealth platform. That was the bit that got hit earlier this year with the Shield Master Fund, a fund that looks like it was full of assets that had been compiled together quite dodgily and ASICs going after them. Macquarie repaid financial advisors who put their money into that fund. So, I mean, that's why Greg Ward's been hit next. But you're right. After that, it's sort of like 10% here, 5% there. Shemara, though, feels the most pain.
Yeah. Okay, Anthony. Well, gas policy's all over the news ahead of the budget on Tuesday. And on Thursday, we saw the government announce a new East Coast gas reservation scheme, which says that 20% of all uncontracted export gas must be diverted to the domestic market in a bid to, well, I guess, shore up our supplies here and hopefully lower domestic prices. Anthony, this is the big hand of government intervening in another market. Is this good policy, or is this the government trying to look tough in the middle of an energy shock?
It's definitely playing politics here, James. I mean, the government's backed away from increasing taxes on gas producers. I think it wants to show it's not completely toothless or tone deaf.
Yeah.
But I mean, the question is whether something like this can be good policy as well. And the announcement's so light on detail. You pointed that out in your column on Thursday afternoon. I mean, domestic gas reservation policy, it's not a new idea. I mean, it's a surprise that they even sort of announced it when they'd already announced it late last year.
Yeah.
You know, they flagged it was going to land between 15 and 25%, and it was bang in the middle at 20% with not a lot of detail. So forgive the cynicism, but it does look like this is more politics driven just ahead of the budget, given that they don't appear to be going harder after the gas producers themselves. I mean, the goal here is to shore up the domestic supplies and protect price. Hopefully this helps to put to bed the chances that we'll be importing LNG at global LNG prices in the near term. Like if you think about it, that's just craziness. We're one of the biggest LNG producers and exporters in the world, that we would then be selling our stuff overseas only to be buying other people's LNG at higher prices in global markets to bring it here in terminals. Like, that's the height of craziness. So, I mean, hopefully this helps scrap that. I mean, we do need gas, though, in the domestic market. Domestic gas policy, it's been all over the shop for the past decade. We've had all sorts of band-aid solutions or wannabe solutions to the sort of the price and supply problem. You know, we've had price caps, domestic gas security mechanism, which notionally gave the right for Federal Resources Minister to pull back the export volumes. But I mean, that's never happened. We've had the gas code of conduct, etc. Investors always want clarity. I mean, the gas producers won't necessarily like that they have to keep 20% of uncontracted volumes for the local market, and that's like a hard and fast rule. But hopefully if this policy's developed up properly and there is more actual detail behind it, it'll give certainty. And, you know, certainty is what's been missing as all these policies have jumped from one side to the other. That's why we haven't had heaps of new supply come into the market. So, you know, the devil's always in the detail. It will be here again as well, James.
Yeah, I think that's right. And the tell here is that this new gas reservation policy, the government told us in December that it would start in January 2027. It's now not starting to June 2027. They've kicked this down the road 6 months. It's a bit of a joke, actually. To trump this up as a sort of complete solution, come on. They've still got to work out all the details. They'll be doing that for another year, probably. So let's just wait and see how that rolls out.
All right, James, let's move to our first big topic of the week, and that's interest rates. On Tuesday, Reserve Bank of Australia Governor Michele Bullock did the inevitable and raised interest rates for the third straight meeting, taking the official cash rate back to 4.35%, which matches the post-pandemic high. James, it went to script, really.
Yeah.
Bullock told us inflation was already too high and was headed higher as the oil price makes its way through the economy. The Monetary Policy Board voted 8-1 in favour of lifting rates, and the market's already telling us there's a 26% chance of a fourth straight rate rise when the board meets again in June. James, you tuned into the press conference. You've had a few days to stew on it since. What do you think Michele Bullock was really trying to tell us this week?
Sorry, this is going to hurt, and it might hurt a lot. There's no great surprise in the message. Inflation was too high before the war in Iran started, and really what Bullock said is all the price hikes from the war in Iran, they still haven't arrived. Yeah, okay, fuel's gone up, diesel's gone up, but the government's blunted that with its fuel excise cut. So really we're waiting for the second and third order effects of the Iran war energy shock to come through. So, the packaging around that thing you buy from the supermarket, that's going up in price, just hasn't hit yet. The food itself, that's going up in price, just hasn't hit yet, but it's coming. The problem is twofold. One is that inflation's too high, needs to be brought back to target. But you can sense that what Bullock is really worried about is that we are moving into a world where Australians just expect prices to go up every single year. It's this idea of inflation expectations getting away from the RBA and becoming embedded in our society and our economy. The Deputy RBA Governor, Andrew Houser, called it the central banker's nightmare for a reason. I reckon you could see at this press conference that it is keeping Michele Bullock up at night. They are in a really, really tough spot. There's a great grab from Michele Bullock on the day, which sort of explains inflation expectations probably better than I can. She always says that she has her mum's friends in mind when she explains stuff, and this was a great piece of communication. Let's hear from Bullock.
These interest rate rises are not going to do anything for inflation in the next 6 months. That's done and dusted. We know that those prices are coming through. Second point I would make is that it's not unreasonable for firms, if they are seeing their cost bases rise because of what's going on, whether it be fertilisers for farmers or fuel, diesel for transport costs, it's not unreasonable for them to want to recover their costs, because the alternative is if they can't, they might end up going bust, and that's not good either. So there's nothing unreasonable about that. What we're trying to guard against is, because we're pretty sure we had excess demand in the system, that it will make it easier for them to do it and easier to pass on perhaps more. And that's the way that the inflation expectations gets embedded. What we're trying to guard against is that once those new price levels are achieved, that people don't think, oh, well, it's normal for things to go up by 4 or 5%. We'll just continue to do that. That's the challenge.
Yeah, that's inflation expectations, isn't it, Anthony?
Sure is, James.
Now, the elephant in the room, of course, on Tuesday, sitting there next to the rate hike, was the upcoming budget. The RBA's efforts to curb inflation are really only going to be as good as the government's ability to show restraint on fiscal spending. Minutes before the rate hike was announced, the Victorian government came out with a cost of living package, which increased spending. What did Bullock have to say about all that?
Yeah, more free trains down in Victoria, hey, James? That's good news. I mean, Michele Bullock, she basically said, look, it doesn't matter who's out there doing the spending. The spending, whether it's the private sector or government or what, it's going to be pushing things in the wrong sort of direction, or the direction that the RBA is really worried about. I mean, she said if the economy is supply constrained, there's little or no productivity growth, then, public sector, private sector, whoever, we've already shown we can't grow the economy at more than 2%. So any spending that's aiming to grow the economy at more than 2%, it's going to give us inflation headache. I mean, we've already got one of those, so it's going to make our headache even worse. So, she said the government needs to think about whether or not there are ways that it can help the inflation problem by looking to constrain demand. I mean, that's like In other words, getting on board what monetary policy is also trying to do. It needs to take money out of the system. So it can do that by taxes. It can do it by cutting spending. And like you said, she pointed out that it's the state governments as much as the federal government. I mean, I thought she handled these government questions pretty well. I mean, they're tough questions for her, particularly ahead of a budget, ahead of what's likely to be a very political budget, because it looks like the government's actually going to put itself out there and try and do a few things, which is good. That's what it was elected for. Obviously, everyone has a boss. She gets installed by the treasurer. He gets elected by the people. So he's playing politics with that in mind. You know, we can sit here, and it's so easy for us to do it, just say, oh, the treasurer should do this, treasurer should do that. Well, the government's sort of got a broader agenda, don't they? And they've always got an eye on the next election, 2028, getting re-elected. But Michele Bullock, I thought she handled it as well as she could have. But just speaking about the budget, you must have been thinking about it a fair bit this week. You headed to Canberra for it early next week. There's been plenty written about it, you know, the CGT reform, negative gearing, maybe some other surprises. If you put the RBA's decision with the budget and what we're told to expect, who's taking the hit out there in Australia to bring down inflation?
Anthony, I worry the people who are going to take the hit, who are going to be asked to help bring down inflation and contribute the most towards that cause, are the same people that Jim Chalmers says he's trying to help with this focus in the budget on intergenerational equality. So what I mean by that is, in some ways, the RBA and the government are sort of trying to tackle the same challenge. And that's that Australia is a really, really rich place. And I know it doesn't feel like that to me necessarily, or to lots of other people in the country, particularly those who don't have lots of assets. But I was speaking this week to UBS's local economist, George Theranos, who's done some great work on the level of household wealth in Australia. Went up $1.5 trillion last year. Year before, went up $1.5 trillion. You know, not only are we one of the richest countries in the world, but our wealth is growing at one of the fastest rates in the world. Again, doesn't always feel like that, but the numbers don't lie. The ratio of wealth to income is now 11 times. And so that is making the RBA's job harder, because people, they hear about this, their consumer confidence might be in the toilet, business confidence might be in the toilet. They're annoyed, they're frustrated, they're saying things are tough. And what do they go out and do? They go out and spend. Because they're really, really rich. I mean, there's no other way to say it. Now, you know, this is the aggregate picture. Not everybody's able to go out and spend. But in aggregate, we are seeing consumption growth hold up. We've had bank results in the last week or so that shows that lending growth to households and businesses is just about as strong as it's been in the last decade. You know, the economy is motoring along. In fact, Theranos' estimate is that in the March quarter, GDP growth will have accelerated to 2.75%. So that makes Michele Bullock's job really, really difficult. She can't stop wealthy older Australians spending. She can't get at their assets. She's only got one tool. And so what does she need to do? She needs to whack harder and harder and harder those often younger middle-class Australians who are actually doing the spending. She needs them to slow down. They don't necessarily have all the assets, though. And so I just wonder if we're going to be absolutely belting this group of Australians who are feeling the pressure of intergenerational inequality worse. I get that Jim Chalmers is trying to help them, and that's what some of these tax changes are designed to tackle. It's interesting, though, Anthony, I hear a lot of these tax changes are designed to sort of take stuff or require older, wealthier Australians to make sacrifices. I don't quite see the reforms that are coming through to boost the incomes or provide more assistance to younger, poorer Australians. So that's the mix that I think I'm waiting to see. Bullock really needs to strangle the consumer to get inflation back under control, and I worry that is going to be a really painful process.
Yeah, good point. You're right. Like, are you really strangling the consumer by bumping up interest rates? Like, we've seen that, you know, there's plenty of people out there that are making money from their higher interest rates on their balances, right, that they're living off. I mean, if anything, it's more money in their pockets. It's chucking that money into the system as much as it is taking borrowers' money out.
That's exactly right. Theranos numbers say that we're earning more interest than we're paying out.
Yeah, right.
You know, that's how asset rich we are. So, Anthony, I guess the big question, though, at the end of the week is, where are rates going next?
Well, Michele Bullock said herself inflation will get up near 5% in June. I think 4.8% for the year to June 30, the RBA thinks. I mean, that's the CPI, trim mean 3.8%. Few saw that coming. We're seeing that rates maybe not the most effective way of stopping it, perhaps less effective as a transfer mechanism, as you were talking about there, James, but that's still the RBA's tool, and the RBA is still mandated to use it at times like this. So you think rates have to go up. Like we said, the market says there's a 24% chance of another hike in June, but it also says there's only one more hike for the rest of this year, James. So that to me, it looks like everyone's going, all right, inflation's going up in the short term. It's likely to be around, but the RBA is actually going to show some restraint and patience and maybe sit on this problem and be happy to live with it a little bit more than it's shown a propensity to in recent months. If you look at the RBA's latest forecast, James, it also came out on Tuesday. They have the trim mean inflation getting back to the 2.5% range in the year to June 2028, so a full 2 years away. And that also assumes that by then unemployment's going to be up to 4.7%, and it's currently at 4.3%. So we need job losses to get there. Yeah, I'm sort of scratching my head a little bit as to how it all plays out, James, but I think in the near term, when inflation's up near 5%, what other choices are they going to have? I mean, the other thing worth watching, and we mentioned it in the intro, the Australian dollar. I mean, we have the highest rates amongst the big developed countries in the world, AAA rated government balance sheet. That attracts money, and that's been coming to Australia. People are saying, all right, I'll come there, I'll take the 4.35% or a bit higher that I can get, and that's driving up the Aussie dollar. So it's now at about 72.5 cents, high since April 2022. It's just sort of been on this steady march higher. It hasn't attracted a lot of attention, and companies aren't really talking about it, but that's ticking away in the background as well.
Yeah, absolutely. I think there's one more hike to come. Definitely, I think the market's right there. Does it come in June or does it come in August? Perhaps August gives the RBA a little bit more time to wait and see what happens. Who knows where the war in Iran will be by then? That could be a really important determining factor. I think, though, Anthony, if there's only going to be one more rate rise, then rates are staying high for a very long time. You know, I think there's a view that rates go up and then they come back down next year. I think it's possible to see that rates go up and they stay at 4.6% or higher for all of 2027.
Is that official Chanticleer guidance, James? I remember the last time you made one of these calls, you got it right. I think rates were on hold for 18 months at the time when no one could believe it. How confident are you in this one?
I'm not ready to chisel it on the tablets quite yet, but that's my thinking at the moment. Like Michele Bullock, I'm in slight wait-and-see mode.
We'll let you claim it if it comes true.
Thank you. But on the RBA's own forecasts, we don't have inflation getting back to target for another 2 years, at which point will be what? Approaching 7 years of inflation being above target? You got to ask, does the target mean anything? Or do we not care about it? Is it a guiding light for the RBA, or is it just a bit of a thing written down somewhere that we don't really care about?
Well, pre-pandemic, it was the opposite, right, James? I mean, they did a decade of inflation below target, and that's one of the reasons why Jim Chalmers came in and sort of tried to rethink the whole RBA process and the Monetary Policy Board and whatever. You know, I think we're seeing it doesn't matter what the structure is, whether inflation's low or high or whatever, that target, it's really hard to hit.
Okay, Anthony, let's move to our second topic. And you spent the week down at the Sheraton Grand Hotel, where it looked like half the ASX and half of its investors were camped out for a few days of presentations and one-on-one speed dating at the annual Macquarie Australia Investment Conference. Now, you saw a stack of companies present down there. It's a great list. BHP, Macquarie, Wesfarmers, Qantas, Charter Hall, HMC Capital, and you got to meet with a stack of Australia's biggest investors. Can you start by telling us, what was the mood in the room like this year? It's been a tough year for fund managers, so are people as, down on the ASX and Australian shares as we have been in recent weeks?
It was more positive than I expected, James. I mean, particularly on the company side, all of them have a story, right? Stock picking is storytelling. Investor relations is all about telling stories. You know, all these companies, they got heaps of plans, strategic, capital allocation, all that stuff. They get knocked around by the external environment, but they all turn up and they twist and evolve that story to sort of tap into what's hot in the external environment. Right now, that's AI, isn't it? AI CapEx, data center development, anything in the sort of materials supply chain that can tap into that thematic. So I thought the companies themselves were pretty positive. I thought investors were more positive as well than I expected. I mean, they're willing to look past what's actually going on at the moment and think about FY27. Obviously, no one knows how long the oil price is going to stay up. No one knows how long the Iran war's going to go for. But I mean, companies are saying, we're all right at the moment. If these things keep as they are for the next 6 to 12 months, then yeah, sure, maybe we're in trouble. So I think investors they got an eye on the future, but they think it's okay at the moment. I mean, one thing that surprised me, James, I thought companies were very polite about the government. Productivity, planning approvals, all that stuff we hear a lot about. Only a few CEOs, from what I could see on stage, were willing to bring it up. SGH's Ryan Stokes, as usual, one of the big voices on this. I heard secondhand that Paul Flynn, the boss of Whitehaven Coal, he got stuck into Queensland about coal royalties, which is par for the course in the mining sector.
Yeah.
So very little public dissent, but I mean, behind closed doors, very different matter. I heard from enough fund managers, people have known for a long time, to know that what they're saying is true. Companies absolutely sticking the boots into the government behind closed doors.
Wow.
They are whinging deluxe about the productivity problem, tax changes, planning approvals, all that sort of stuff. They just don't want to say it publicly.
Totally.
For fear of retribution, which feels like a bit of a waste, when the budget's only next week. But I mean, I sort of get it from their perspective too. I mean, what are you going to say right now that's going to change the budget?
No,
nothing. It's all set in stone. In terms of the mood in the room, James, the crowds, there was plenty of people there, probably consistent with last year. I'd say a lot of fund managers with name tags I wasn't familiar with. People that come from out of town, and they say they come just to meet the other fund managers to sort of road test their ideas to make sure that the stocks they're looking at, they haven't completely lost the plot, and there are sort of reasonable stories around them. There's lots more blokes than women. We got some feedback this week from senior banker Sarah, who said we shouldn't just talk about the suit colours. It perpetuates this finance is only for blokes story, and that's true. So I do apologise to Sarah. There are plenty of women in the game. They're doing well in funds management and in banking, but there are still heaps more blokes, even 25 years after the industry created things like women in banking and finance to fix it. There's a long way to go.
Yeah, absolutely. But Anthony, give us 3 lessons from your time down there on the conference floor.
Well, the first one has to be AI, James. I mean, there's nothing else worth talking about in regards to markets at the moment. I mean, we went through it last week in detail. It's such a dominant theme in markets, AI winners, picks and shovels, big tech cash flows, all that sort of stuff. We don't have Meta, we don't have Amazon, we don't have Nvidia here in Australia, but we have plenty of companies hitching a ride to the data center build out. So, we've got energy companies who say they're in direct conversations with data center developers about either supplying power to the data centers or building the backup, the battery storage, that sort of stuff. They say those discussions are red hot, live, announcements coming shortly. We've been hearing that for a little while, but surely it's getting closer just with some of the contracts we're seeing signed in the market. I mean, even normal, pretty boring and truthful to be believed companies like Ryan Stokes' SDH, which sells Caterpillar mining trucks. I mean, it's also selling sort of energy systems for Caterpillar as well, trying to hitch in on this energy transition story. Investment firms like Solpats, they're saying, don't forget about us. We have this big electrical engineering business that we own.
Yeah.
Real estate companies are either selling land to data center developers or doing JVs to sort of develop on their land. You got the miners talking up their copper. So there's just, like I said, there's just so many of these sort of AI stories out there at the moment, which you don't have to be a full bull to believe that these companies should benefit in some way. There's just that much spending going on.
Yeah.
Second lesson for me, James, this one's been coming for a while, but it hit home for me when I was listening to JB Hi-Fi. This health, beauty, wellness, wearables sort of trend is huge.
Yeah.
Watch JB Hi-Fi's product range evolve over the next few years. Everything from Meta glasses to face masks that make your skin better, all this sort of stuff. We're going to have so much more stuff to plug in at home. And JB Hi-Fi, it's only going to sell it if there's demand for it. And they say, you probably don't notice it day by day, but what we're selling in stores changing a lot. And it's skewing towards this health, beauty, wellness category that's really come from nowhere. Remember, it used to just be the supermarkets, with an aisle of, shampoo or whatever, and that's all we really thought of it. Well, now it's changing what the Kmarts and the big department stores are selling. It's really bankroll Chemist Warehouse's rise. It's changing JB Hi-Fi's product set.
Changing the supermarkets too. I saw Coles boss Leah Weckert this week. The two products they cannot keep on the shelves at the moment are cottage cheese and high-protein yogurt.
There you go.
Everything to do with health and wellness related products, including products for people who are on Ozempic and similar drugs, are flying off the shelves.
There you go. Well, the third one, James, I mean, this comes back to what we were just talking about in the interest rate sections, is travel. And listening to Qantas's Vanessa Hudson, like, what economic slowdown? You know, when they announced they were cutting capacity a few weeks ago, I wrote, surely that's a sign that they think the economy is softening. But she says, no, it's just a price thing. It's just about managing price and trying to protect profits. Demand is no problem, which sort of makes me wonder why they don't just increase prices without cutting capacity. I mean, that to me, that sounds the more rational thing. But, I mean, she says it's all part of the aviation sector's secret sauce, that managing volume and price to get the best margin. She said capacity is down 20% globally, James, in the aviation sector because of the oil price, what's going on in the Middle East with some of the Middle East carriers. That's why prices are so high. But it's funny, I think we've been hearing, haven't we, ever since the pandemic, that Australians' propensity to travel is just going up and up and up.
Yeah. Again, it comes back to that asset thing. We're just so rich. We're just so asset rich, and those assets are flowing through to and influencing the way we spend. Anthony, I'd love to know, I always love this, I know it's very anecdotal, but which companies pull the biggest crowds? Because it's a great sign of, you know, who's hot and who's not.
The big caps, James, I'd say. Like, often it's the small caps that have people spilling out of the rooms. I reckon this year there was much more interest in the big caps. And I don't know if that's because some of them have been running hard or what. So Qantas, like I said, obviously very topical because of the oil price. BHP, CFO Vandita Pant, I mean, she started by explaining why the company's share price had gone to $55, where it's never been before recently. And she says it's all new investors who are bidding up the stock. You know, offshore fund managers in particular that are buying it for the copper exposure to the AI story. I mean, that was a full room. JB Hi-Fi, Wesfarmers, like I said, the big end of town. At the smaller end of town, I mean, Breville had a full room, always does. Yeah. It's just such a interesting business. Sort of, you got the parts, the coffee machines and parts and everything made in Asia, sold in the US. It's really at that heart of that China versus US trade sort of story, but it just happens to be listed here in Australia. Sharon AI, the new neocloud, wants to come to the ASX. We haven't written much about it, but it's like a Firmus. It was packed to the rafters. The energy companies, a lot more interest in them than usual, just given the energy shock that's going on, which is understandable. And I'd say the real estate firms, your Dexus, Charter Hall, Stockland, I reckon their rooms were quieter than they have been in the past few years. It's just not the time for them. Rates going up is not normally good for them. Apparently, I mean, the bosses of those companies say, no, that's not true. We had heaps of one-on-one meetings. Investors are interested. But just from what I saw on the floor, there seemed to be less.
No, very good.
But James, like the whole conference, there's lots of talk about who's winning, who isn't, whether there's been a changing the guard in Australian equity markets. I'll bring in a question here from Brendan, James, because I think it's very relevant from a bunch of conversations that I had on the sidelines. And he asks, what is a defensive stock these days for when times look tough? I remember being told to view defensive as when the going gets tough, the tough go smoking, drinking, gambling, eating fast food, and end up in hospital. But all the stocks in these sectors on the ASX, so we're talking Aristocrat, Collins Foods, Cochlear, CSL, Domino's, Endeavour, Star, Metcash, Woolworths, etc., seem to be shaky at best. Do defensive stocks still exist, or is it just a label companies will wheel out if the economy gets worse? What do you think?
I think defensive stocks do still exist, and some of those have done okay. Woolworths has come back pretty hard. Wesfarmers is a pretty defensive retailer. It's done pretty well. I think, Anthony, it comes back to your point about the mood of investors. They just don't believe there's any reason to be defensive at the moment. They don't think this Iran thing's going to end. They don't really care about inflation because, people still keep spending. And they're looking over at the US and they're thinking, what's the story about? It's about AI. And there's no reason, there's no possible ability to be defensive when it comes to AI. You just jump in boots and all. So I think there are some good questions, though, Anthony, about whether some of these so-called defensive stocks, their models have cracked a little bit. A Cochlear and a CSL, we've been talking about those in the last few weeks. Once they were defensive, but now they're, after a few profit downgrades, suddenly they're less trustworthy than they might have been, perhaps. So I think the idea of defensive stocks is still there and still valid, but I just don't think there's been a time in the last, probably 5 years where it's paid to be defensive. So why do you want to spend too much time thinking about defensive stocks? I'm giving my view here, not financial advice, but that'd be my take. I don't know. What's yours?
I think investors are rethinking how defensive some of these companies' earnings actually are. So if you look at that list, I mean, some of them are just on the wrong side of changes in society that seem like they're going to be hard to slow, like Domino's Pizza, for example. I mean, how many $5 and $10 pizzas and people shopping for $5 and $10 pizza, that cheaper end of the pizza spectrum, how many of those are out there? I'd argue there's a lot fewer than there used to be for exactly the same reasons we spoke about in the interest rates segment, James. It feels like there's more money out there. I mean, Endeavour, and people are drinking less, right? It owns Dan Murphy's, BWS, and a bunch of pubs.
Yep.
Alcohol consumption's on the way down. It's a global trend. I mean, that's just a fact. Star Entertainment, you've got governments that are clamping down on casino operators, making it really hard for them to make the money that they used to. So how defensive are those earnings now? So I think, for a variety of reasons, just the companies that had defensive qualities, maybe they're just not as defensive as we always thought, and that's why they're under pressure.
Yeah, well said, Anthony. All right, we'll come back after the break. As we said, it's all eyes on Canberra next Tuesday. Let's have a look at what the budget might hold in a sec. Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, I'm Canberra bound this week, but before we get the budget, we'll get the latest readings on Australian consumer and business confidence, which absolutely crashed to sort of the worst readings in history last month. Any chance of a rebound?
Oh, there might be a slight rebound, but I reckon it's all still too soon to expect, any miracles.
Yeah. I guess the fuel excise cut might help a little bit. And then Tuesday afternoon, Anthony, I'm locked up in the Canberra Bureau of the Financial Review inside Parliament House. We'll be out at 7:30 with all the analysis and winners and losers and detail of the budget. What are you going to be watching? What do you think I should really hone in on?
Well, it's hard because, we tend to look at companies and corporates and what they're doing, but I think the budget, James, this year is going to be about the attack on individuals. It's the attack on investors through the CGT reforms, the attack on housing investors through negative gearing. I think it's really going to be more about going after individuals and their circumstances than it is business. So, I mean, if you're thinking about business is just going to be paying more and more and more tax. And I think the government is going to be going after individuals. I'm not expecting anything huge for business. What about yourself?
We're being told this is about intergenerational equality or inequality. I can see the thrust of those tax changes, are aimed at taxing wealth rather than income. I get that. But what I want to see is what's the suite of reforms to help grow the economy for those younger Australians who are, going to be making their way over the next couple of decades. That's the missing piece in all this discussion that I really hope is going to be there on Tuesday night, but we'll see. And Anthony, Tuesday night our time is the big one in the US. Inflation numbers. And I guess this is going to tell us a little bit about what's the impact of the war in America on prices.
Yeah, I mean, we've seen it here. America is supposed to be more sheltered from it, bigger energy exporter and user of its own energy than we are in Australia. But surely it's creeping through their supply chains just as it is here.
Yeah, gasoline prices are at highest in about 5 years, so that's going to hurt. Okay, Anthony, we love questions here on the Chanticleer podcast. If you've got a question you can want to send in, you can email us at chanticleer@afr.com. You'll find the link in our show notes, or you can send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. And of course, there's a widget on the bottom of every Chanticleer article, so you can also send us a question that way. We love getting these questions, and we're really getting a great flow. Just try and keep them short for us so we can feature as many as possible on the pod. Well, this week's question comes from Chung Wei in Melbourne, and we'll get Mandy, our producer, to do the honours.
Hi, Chooks. Can you answer a mystery around the Big Four banking valuations after recent profit results? Specifically between ANZ NAB and Westpac. ANZ had reported a bigger cash profit, faster profit growth and has a higher dividend yield, yet has a lower market cap than NAB and Westpac. Why is the market discounting ANZ so heavily relative to its peers, despite its better performance?
Well, interesting question, Anthony, and it sounds like it's come from deep within the bowels of ANZ, or at least an ANZ investor hoping they get a better return on their stocks. Now, ANZ's shares have performed pretty well, Anthony, and their profit story was pretty good last week. Big cost cuts helping to drive profits. But I think the question here, Anthony, is can CEO Nuno Matos finish the job on his turnaround plan, which is still really in its early stages?
Yeah, true, James. I mean, I'd take it one step back even further and say, look, of the big four banks, the market says ANZ's the lowest quality of the banks. So it's the cheapest of the banks in terms of buying its shares. So it has to basically earn more profit to get its shares to go up than anyone else. So, I mean, I think the result last week was pretty good, James, but the reality is the market's saying that this is the lowest quality bank. Why? We went through that story last week. Issues it's had in the past. The structure is different. It plays in the big sort of institutional clients, markets, business, more so than deposits and mortgages. Investors think that's a bit more fleeting or volatile, that revenue, than the sticky Australian stuff. And there's also sort of like a trust thing as well. I mean, ANZ's been through a few issues in the past decade. Maybe it hasn't been the best user of capital at times. So it's sort of trying to win back that trust to get its valuation up. And at the moment, it's been a bit too soon for Nuno to do that.
Yeah, the profit growth was great in the period just gone. You've got to remember, though, that's what happens when you cut 3,500 jobs. There's not another 3,500 jobs to cut next time. So now the challenge becomes to grow profit through ordinary business, and that'll be a little bit more difficult. So I think the market's probably right to wait and see how that all rolls out. Okay, Anthony, it's been a big week. Well done on bringing us all the insights from the Macquarie Conference. It sounds like a great event. And we'll be back next week, Anthony, to dissect the federal budget. Can't wait.
Yeah, enjoy Canberra, James. It sounds like you're going to be trying to fight for the young people. So I hope you find something worth fighting for.
I'm young at heart at best, Anthony. We'll see you all next week. If you like the podcast, send it to a friend as it helps others find us. And don't forget to follow wherever you get your podcasts so you'll never miss an episode. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Mandy Corlin. Head of audio is Alex Gow, who also composed our theme. And the head of premium content is Fiona Buffini.
The Australian Financial Review.